welcome you once again to the lesson. Today's lesson is on planning for new and existing audit clients. The subject is auditing and assurance. We will be discussing how to plan for new clients and also existing audit clients, because audit planning, as we learned in our last session, is a crucial first step in any audit engagement, but the approach and the considerations differ significantly between, on the one hand, new clients and existing clients. So we will begin with the existing clients. How do you plan for, new clients? How do you plan for new audit clients? Let's begin with the new audit clients. New clients. New audit clients. These are clients that have never been audited before by the audit firm. And auditing a new client presents unique challenges because the audit firm has no prior experience with the entity that is being audited for the first time. And therefore, the planning phase for a new client is typically more extensive and rigorous compared to planning for an existing client. So what are the key considerations and procedures? So procedure number one, when auditing a new client, and considerations. The first procedure or consideration is client acceptance procedures. This is what we call client acceptance. Before planning for a new audit client, there are certain procedures initially that have to be considered. And these are sometimes referred to as pre-engagement activities. And this is the most critical step for a new client. The audit firm must decide whether to accept the engagement in the first place. And that may involve assessing client integrity, and reputation. Assessing client integrity and reputation. The audit firm must carry out a background check on key management, on owners, and also those charged with governance. The audit firm may also inquire with third parties like bankers, legal counsel, industry peers, and so on, and just simply reviewing the client's history, including any participation in past litigation, or regulatory sanctions, or even public controversies. The company previously been involved in public controversies, so that is very important. The audit firm should also try to understand the nature of the client's operations and reputation in the industry. What is the reputation of the company in the industry? This forms part of the procedures, client acceptance procedures, that have to be carried out before accepting an engagement. The second consideration is evaluating firm's competence and resources. The auditor has to evaluate the audit firm's competence and resources. Does the audit firm have the necessary industry experience or expertise? Does the auditor have sufficient qualified staff available? Does the firm have the technical knowledge for client-specific accounting systems, complex transactions, or specialized industry regulations? And can the audit be completed within the required time frame and budget? That's what we are referring to as evaluating the firm's competence and resources. That's a very key procedure or consideration when planning for a new audit client. 3, assessing independence. The auditor has to assess his own independence. Assessing independence and ethical requirements. Assessing independence and ethical requirements. That means identifying any potential conflicts of interest or threats to independence. The auditor, we call candidates, one of the key features or characteristics or requirement of an auditor is for the auditor to be independent of the firm that is being audited. The auditor has to assess whether the audit firm is independent, because an audit is required to give an opinion that is independent. So the auditor has to identify if there are any financial interests or even family relationships that may jeopardize the independence of the auditor. The auditor has also to ensure, we're talking about ethical requirement. The auditor has to ensure compliance with ethical codes, okay, and so on. 4, communication predecessor. Communication with the predecessor auditor. Before planning for a new client, the incoming auditor has to communicate with the outgoing auditor, if any. That means obtaining client's permission to communicate with the previous auditor. The auditor has to seek permission from the company that is being audited. This is permission to communicate with the outgoing auditor and inquire about reasons for the change in auditors, and just discussing any disagreements with the management. If the company has internal controls that are weak, the outgoing auditor can inform the incoming auditor. You understand? Yes. Another point is reviewing pertinent regulatory rules. When planning for a new client, the auditor has to review pertinent regulatory rules. The auditor has to understand specific regulations that apply to the client's industry or legal structure. You understand? Yes. That is self-explanatory. Then number 6, you have what we call engagement. Engagement letter. Engagement letter. Once accepted, a detailed engagement letter must be prepared and signed by both parties, clearly outlining the objective and scope of the audit, responsibilities of the auditor and management, identification of the applicable financial reporting framework, expected form and content of reports, the fees and billing arrangements, and so on. That is part of the engagement letter, which we studied earlier on. Contents of an engagement letter. The letter has to be drafted, and the letter then has to be signed by both the auditor and the client. So candidates, we are discussing the procedures and considerations for planning for a new audit client. Understand? So this is procedures. These are procedures, and maybe this we can call it A. We've done A. Let's go to B. The first one is client acceptance. These are client acceptance procedures. Client acceptance procedures. Okay? Client acceptance procedures. We can call this A. Then this is 1. Move to B. Okay? Client acceptance procedures 1. Client acceptance procedures. Then we move to the second part of planning for new audit client, which is gaining deep understanding of the entity. Gaining understanding of the entity. and its environment. After the engagement letter has been signed, a contract has been drafted, then the auditor moves to the second step, which is gaining deep understanding of the entity. Here the understanding was superficial. Here the auditor gets into a deep understanding of the client and the environment in which the client operates, gaining deep understanding of the client. And one way to do so is studying business operations. One, business operations, like the products. The auditor should understand the product, should know the services, the customers, the suppliers, the operations, and the organizational structure. Number two, industry and regulatory framework or environment. Okay. Here the auditor has to interact with the key personnel, the board of directors, the audit committee, and so on. Then there is accounting policies. What are the client's accounting policies? By studying accounting policy, the auditor will also be gaining deep understanding of the entity, understanding the client's accounting methods, the key accounting estimates, and also information technology systems that are in place. For internal controls. Internal controls, the auditor should do a thorough initial assessment of the design and also the implementation of internal controls. There is no prior working knowledge of the effectiveness because it's a new client. Given that this is a new client, the auditor may not have any prior knowledge on the operations of the internal control system, and therefore the auditor has to do an evaluation, carry out an evaluation of the internal control system. There is financial performance. Financial performance. Understanding the financial performance of the company also goes a long way in helping the auditor understand, gaining a deep understanding of the entity. Analyzing financial statements, for example, coming up with key ratios and also trends for available historical data. So these are 6 ways in which the auditor may understand gain a deep understanding of the entity. So that's the second thing to do. The first thing is to run client acceptance procedures. Number 2, gain deep understanding of the entity. Then number 3, the auditor moves to the third stage, which is initial risk assessment. C, initial risk assessment. Initial risk assessment. Now, given the lack of historical knowledge, the inherent risk for a new client is often initially assessed as higher because more extensive risk assessment procedures are performed to identify potential risks of material misstatement, both at the financial statements level and also assertion level. And this includes inquiring with management, includes observation, and also analytical procedures. Initial risk assessment is the third thing to do in planning for a new client. 4 is to determine materiality. Determine materiality. This means establishing materiality levels requiring careful judgment due to limited historical data and also understanding. Because we record this is a new client, the auditor has never audited this client before, and it's important to determine materiality levels. The auditor has to establish materiality levels, and that requires careful judgment due to limited information about this company in previous. So that is determination of or calculation of materiality. 5 is to develop audit strategy. Step number 5 is to develop audit strategy and plan. At a later stage, we'll delve in deeply into the meaning of audit plan and also audit strategy and their relationship. There is a subtopic on the relationship between audit strategy and audit plan. We'll get deep understanding when we get to that topic. But we can just mention that the audit strategy will likely be more conservative. When auditing a new client, the strategy has to be more conservative, leaning towards substantive approach given the initial uncertainty regarding internal control effectiveness. And the detailed audit plan will incorporate in extensive procedures for understanding the client and its controls. Understand? Yes. Then 6, we have opening balances. Opening balances. Here, candidates special attention to verify opening balances for the audit period to ensure consistency on and correctness has to be done. Special attention to verify opening balances. So these are 6 procedures to perform when auditing a new client. Let's move to existing client. Existing. Now, auditing an existing client may not be as rigorous as planning for a new audit client. Okay. For existing clients, the audit firm has historical relationship. It also has accumulated knowledge which can streamline the planning process. However, it's not simply a repetition of the previous year's audit, and therefore there are also certain key considerations and procedures that the auditor has to perform. One such procedure is client continuance procedures. Client continuance procedures. That is one step to take. Like what we call evaluation of whether to continue to audit the engagement. Annually evaluate whether to continue the audit engagement. Evaluate to continue with the audit engagement. Evaluate. This is a client that you've been auditing all the years, but it's not guaranteed that you must audit the firm in subsequent years. And this evaluation may be done by reassessing client integrity, checking if there are any new legal issues or changes in management. It can also include evaluating the firm's competence and ability to continue serving the client. As an auditor, you also need to check if there are any changes in the firm that you are auditing that may hinder you from successfully or competently carrying out the engagement. If there are changes in the client that you feel you may not be able to complete the audit competently, then you should not continue auditing that company. Evaluate. You have to evaluate your competence and ability to continue serving the client. You may also need to reevaluate independence and ethical compliance. So all these things, I'm just talking about what we discussed here. Reevaluate, reassess your independence. If your independence is compromised, then you should not continue auditing, or you should put in place safeguards, okay, against lack of independence. So reevaluate. You have to reevaluate, okay? Then review any conflicts or disagreements from previous audits. So that's one thing to do. when carrying out client continuance procedures. Evaluate whether to continue with the engagement. Then there is the engagement letter, number 2. Engagement letter. While a new engagement letter may not be required every year, the auditor should assess if circumstances necessitate revision of terms or reminder to the client of existing terms. You may need to do a letter if there are any changes, or just as a way of reminding the client of the terms and conditions of the engagement. That's another procedure to carry out. Draft an engagement letter. So that is step number 1 on client continuance procedures. Now, after drafting the engagement letter and the engagement letter has been signed, then the auditor can now proceed to the next step, which is leveraging prior year's knowledge. Leverage prior year's knowledge and communication. That means reviewing of previous audit files. Review previous audit files. Because this is a continuing client, there are already audit files in place, so the auditor should review the previous year's audit files to understand prior year's audit findings, significant risks, internal control weaknesses, and also management letters. 2. Continuity of audit team. Continuity of audit team. Ideally, some team members from the previous year will be involved to leverage their institutional knowledge. So if you are continuing with the client candidates, you don't replace all the previous team members who have worked for that company before. It's important to retain some of them because of the experience they've gained and also due to institutional knowledge. 3. Understand changes in the client's business. Understand changes in the entity. That means identifying any significant changes in client's business. The client may have, for example, new products or services. The client may have merged or acquired another company, or the divestitures. There could also be changes in IT systems, changes in accounting policies. There could be changes in internal control systems. There could be changes in personnel. There could be changes and in internal controls and so on. There could also be updates in industry trends or even regulatory environment. So the auditor has to understand the changes in the client business. 3. Update risk. Update risk assessment. That means evaluating previous identified risks, considering any changes in the client's environment or internal controls. That may also mean identifying any new risks that may have emerged, and also assessing the effectiveness of internal control based on prior year testing and current year changes. And if controls are deemed effective, a more reliance-based audit approach may be adopted. So that is step number 3 when planning for an existing client. Step number 4 is to review materiality. Review materiality. This step in auditing new clients, the step here is to determine new materiality. But when you are auditing existing client, then you review the existing materiality. You review it. You understand? You re-evaluate materiality levels based on current financial information and any changes in the client's circumstances. Then lastly, number 5, the 5th procedure in planning for an existing client is what we call efficiency gains. efficiency gains. But before efficiency gains, candidates, there is refining audit plan. How could I forget that? Audit plan. There is audit plan here. My points, candidates, are just derived from what we had here initially, but we are reviewing or revisiting, revise, audit, refine strategy, and audit plan. The audit strategy and audit plan may need to be revised because of the prevailing changes. Okay, the auditor has to adjust the audit strategy, shifting from substantive to reliance based if controls have improved and are efficient. The auditor may also need to tailor the detailed audit plan to address specific risks and changes identified during the current planning phase. And focus should be on audit efforts on areas with higher perceived risk and where significant changes have occurred. That is number 5. Then there is number 6, efficiency gain. Number 6. Now, what do we mean by efficiency gain? Efficiency gain. Here, candidates, the auditor can often achieve greater efficiency due to familiarity with the client's operations, because this is not a new client. And again, because of the existing understanding of the internal controls and availability of prior year's audit documentation, the auditor can leverage and gain efficiency as a result of his association with the existing client. And that's all, candidates, we can discuss for today's lesson in relation to today's topic on planning for new and existing audit clients. So there are 2 things. New client, we've identified the procedures for when planning for a new audit client. One is to carry out client acceptance procedures. Number 2 is to gain deep understanding of the entity, because the auditor is auditing this firm for the first time. Understand deeply the entity and its environment, like business operations, what are the products, what are the services, what is the organization structure, and so on. To understand the auditors, the entity, the auditor has to study the regulatory and industry environment, the accounting policies, internal controls, financial performance. These are financial statements. Then step number 3 is to do initial risk assessment. Step number 4 is to determine materiality. Step number 5, develop audit strategy and audit plan. Then there is also opening balances. We've gone ahead to discuss what is required when planning for an existing client, and we've seen that for an existing client, the procedures are not as rigorous as planning for a new client, because here the company will first of all run client continuous procedures to evaluate whether to continue with the engagement. Then if the auditor decides to continue with the engagement, the auditor has to draft a new engagement letter or revised one, depending on the changes that have occurred. And then a year's knowledge, because he's audited the company before. Step number 3 is to update risk assessment, to review materiality, and also refine the audit strategy in light of any changes in the business. So in both new candidates you've seen and existing client engagements, audit planning is an iterative and dynamic process. It requires continuous communication with the management, assessment of risks, and also flexibility to adapt the audit approach as new information emerges. And the goal remains the same. The goal remains the same. The goal is to conduct an effective and an efficient audit that provides reasonable assurance about the presentation of the financial statements. The goal remains the same whether you are auditing a new client or an existing client. That is all for today's lesson. God bless you. We hope to meet you in our next session where we'll continue to share knowledge in auditing. Bye-bye.